Okay, Malcolm, there's a ton of economic and stock stories that we're going to get to later, but I really want to talk about the Michael Jackson movie, even though I have not seen it yet. I have not seen it yet. I think I will see it. I was thinking about going on Saturday, and then I had already seen a musical that day. So I was like, I don't think I can do, just my brain, I don't know if I want two musicals right now. But I think this is such an interesting story because it is a place where economic reality diverges so drastically from the internet. Michael, in the opening weekend, made $217 million worldwide. It's the biggest biopic opening ever, bigger than Christopher Nolan's Oppenheimer, and smashed especially domestic box office expectations, making a little over 92 million versus 65, 70 expected. And usually people follow what the critics say. This movie has a 38% critic score on Rotten Tomatoes and a 97% audience score, because I think critics wanted a harsher look at Michael Jackson. And there are enough people that say, the music means so much to me. I'm okay with this concert roller coaster ride. And you know what? I can't really blame that either.
So I did see it. I won't ruin it for you or any of our listeners, but I
Can
will
it be
say,
spoiled?
Yeah, maybe. I don't know. But, you know,
that's not a clean yes.
Yeah, well, because you know how the story goes. This guy's lived a whole bunch of years and then has been gone for quite a few years. So, right, like you would assume everybody knows how this story ends. It doesn't really focus on that aspect of his life anyway. It ends on a very high note.
Yeah. Wasn't it the Dangerous Tour or the Bad Tour or something?
It's not a musical, though. Like, interestingly enough.
Okay.
Which I can appreciate as a person who hates musicals. Or maybe it is a musical and I just like Michael Jackson's music enough that I don't care that it's a musical. Maybe that's actually what it is. I don't know.
Is anyway. Jafar Jackson doing Michael Jackson songs for an extended period of time throughout the movie?
Maybe. I can't tell whether it is whether they're playing the original or if it is actually him singing. And I was trying to figure that out throughout the entire. So here's one of the things that I don't think will ruin anything for anybody. There were very clearly some parts of the movie that were enhanced by AI.
Okay.
And there are parts of the movie where you're watching and it's like almost identical to what your brain remembers seeing Michael Jackson do and perform. And at first I thought, like in some cases, like they actually cut clips of him doing and like whatever. But no, that's the magic of AI being part of the production process. It's like you have a person who is in makeup with prosthetics and everything else and is made up to look like the person. But then you also have the ability to throw a filter on it using AI to get you the rest of the way. And so with the same thing with the singing that you were asking about, can he make his voice sound identical to a Michael Jackson track? Or can we fine tune this thing with AI enough that it sounds identical to the way it's supposed to? And I went to see it in IMAX specifically because I wanted the whole sound experience along with what I was seeing. And it's worth it. Like it's worth going to experience this way. I don't know that I would have been as interested in watching this on Netflix or something at home.
Yeah.
So it's worth going to see. And I also think you as a viewer still can there's nothing to ruin as you're asking, but I think it's still stuff in the movie that if I said it to you now, it might take away from your experience going to see the movie.
Okay.
I don't know how to say that any better.
I have a higher barrier for spoilers. And could you tell it was AI, or were you just unsure? You're like,
no, unsure.
The nephew could be so good that
yes.
he's hitting the moonwalk just like Michael Jackson.
He very clearly was dancing himself. He very clearly is that good a dancer and mimicking Michael Jackson's movements because, just down to the littlest tick, he got it. And you could tell he spent a lot of time studying and preparing to do that performance. And I guess, by being his blood, you already automatically had some of that built in. But yeah, you can tell if you're watching with a skeptical eye.
Okay, so Conspiracy Corner, I have not seen Jafar Jackson doing a lot of live performances on late night shows. which, you know, when Timothy Chalamet did Bob Dylan, he goes on SNL and he sings live kind of as Bob Dylan. And so maybe there's some AI in there. I'll end up checking it out. The other financial angle on this that I want to talk about, because I think it is interesting as well, is sort of what's your number? You, the listener, if you have a number on let us know on Spotify. This is the number I'm asking. So the original script for this movie kind of addressed the abuse allegations head on. It painted Michael Jackson as basically the victim of people who wanted to extort him. But as they were making this movie, they didn't realize that a legal clause in one of the settlements they gave to the alleged victims banned them from using their depiction for commercial reasons. So I think my guess is that the director, Antoine Fuqua, is a little upset about this, in part because you're changing the story and also you're doing it at the last minute. There's a lot of schedules that you got to get right with. Coleman Domingo's in the movie, Miles Teller's in the movie. And you need to change it, make a big change in the last minute. And so the director, he gets an extra $15 million. He's originally supposed to make $10 million to make these changes. And Matt Bellany also should shout out. He did the original reporting on what that script looked like. So I thought I was looking at that. He got some heat on the internet of, I can't believe you took a check to sanitize this movie.
Well, so I heard somebody ask him about that, and I didn't know any of this actually at the time. The response he gave was basically like, we wanted this to focus on his art. We didn't feel it was necessary to dig that deep into like his transgressions, shall I say.
That's completely untrue. No,
I didn't know that at the time that I read it though. And I said, all right, that's fair. Like I just kind of brushed it off as, you know, that fine. You're making the movie. You make it from the angle you want to make it. I didn't realize that there was a $15 million payday attached to that response. I will tell you though, in all honesty, it doesn't change anything for me at all. Like this is still, in my opinion, the best biopic that's ever been made. I really liked the Whitney Houston one. This is better than that to me.
Okay.
But also I take your point that like someone's offering you $15 million to alter the movie. As the director, why would you say no? Like there's plenty of people who have said, no, I'm willing to die for my art, that did just that. And we'll never know their name. This movie may have never gotten seen, which is like a director's worst nightmare. Is that they make a movie that no one ever sees because of something with the studio. Or if you think about a little bit of a diversion real quick, but it'll make sense. If you think about the movie The Dictator that Sony made with, what's
Seth Rogen.
Name? Seth Rogen and one of his buddies that he always makes movies with. Franco. So they made that movie despite the number of people who said, no, this is a terrible idea. Don't make this movie. North Korea will be pissed. People told Sony, don't make this movie. Everybody will be pissed, including the leader, Kim Jong-un. They made it anyway. They got hacked. And all of a sudden, all their emails leaked all over the internet and the CEO like leaves in disgrace. So there's the risk that happens to you as the director. And you're thinking about that. There's a chance that I say no here and nobody ever sees this movie that I just spent all this time making. I don't want that to happen. So I take the carrot instead of the stick. Like I completely understand the logic.
You're also balancing two things. Number one is now you have a new legal settlement that you have to deal with, or not new legal settlement, but new news of a legal settlement you have to deal with. And the other thing is that when you went into this project, you knew you had to get the cooperation of Michael Jackson's estate. If you want to use the music, you got to get the estate's cooperation. So yeah, they're going to be a little persnickety on the image. So it's one of those things where the internet is very upset about this movie, but the economy has been able to say, no, we want to go see the music. And this is such an important figure. And his music is so important to me and to my family. And what I did instead of seeing that music or seeing the movie, Malcolm, they have his live concerts on YouTube. So, because my only memory of Michael Jackson was him around like the mid 2000s when I was a kid. And I'm like, who is this weirdo?
When stuff got weird. Yeah.
And then I watched Live in Bucharest, the Dangerous tour, almost like is a bit at first. And then I was locked in. I'm like, no one told me how good this guy was. Yeah. So anyway.
And that's the impressive part about watching his nephew dance, assuming his dancing has not been altered. that is what makes it so impressive, is how he nailed each and every little movement that is unique to Michael Jackson.
All right. Today on the show, Malcolm is going to explain to me why he is selling his ASML shares. It's a big position for me, so I want to find out why. There is an arrest for a sketchy prediction markets bet that I want to get to. Big tech layoffs that's worth spending a lot of time on, explaining why these companies are doing this, and also the personal financial angles, and a big problem for car dealerships, which is that a huge wave of leased electric vehicles are coming back in the next few years. Let's get into it. So Malcolm, you said on CNBC that you are selling ASML, which makes the machines that makes the machines that make the advanced chips that Nvidia makes, as well as Nvidia. ASML is one of my largest stock positions right now. It's one I did a little bit of trimming on simply because it got to my sleep number. But I want you to give me the case on this. You are taking a little bit of a contrarian position into software, a little bit out on AI. If you can break it down, I'd appreciate it as someone who owns shares in one of these companies.
Yeah, so this was actually one of my the top 5 largest positions too. For context, I only own, I think 21 positions are owned before this. So I have a pretty concentrated personal portfolio anyway. However, ASML was in the top 5. I think it was number 4. And the thing I had been thinking for a while was this stock has run a ton since I bought it in August of 2025. So for context, I think my entry point was 691, if I remember right. So at the time, the narrative around the stock, all the analysts on the street were saying this thing's hit its growth ceiling. There's no more good news that you can tell us about ASML and how much Taiwan Semi is going to buy from them that's going to impress me. Well, that turned out to not be true, which was the bet that I was making. I figured that it had fallen so much that you can't fall off the floor is the phrase that I keep using, that I'm now learning as it relates to software that I better stop saying. But anyway, so ASML ran to 1450, I think.
We're at 1440 right now as we record on Monday.
And then Taiwan Semi reported their earnings, and their CFO took it upon himself, almost unprompted, to say ASML wants us to upgrade to their newest machines, which are capable of getting to a much smaller nanometer chip than what they produce today. But it would cost us about $400 million per unit if we were to upgrade to their newest machine. I don't know which of all of the available ASML machines Taiwan Semi is currently running, but just the entry level, the base model ASML machine today is about $200 million.
The Honda Civic.
Right. The Honda Civic of chip manufacturing is $200 million at this point. And so there's clearly a pretty large delta between what they currently own and what it would cost them to upgrade to a nice fully loaded Honda Odyssey, let's say. And Taiwan Semi is saying thanks, but no thanks. One of the things that made me want to own ASML in the first place was Taiwan Semi had committed to $50+ billion a year in CapEx as it relates to them making themselves more attractive on behalf of their big customers like Samsung and Nvidia and whoever else matters in that space, Broadcom to some degree, I guess. And they're now saying, yes, we are still committed to spending $57 billion this year in CapEx. However, we don't need to use any of that to upgrade to the nicest, newest ASML machines because we believe we can still squeeze out the same level of productivity we currently enjoy between now and 2029 using the same equipment we already have. Well, then, if your number one customer by a long shot has just said, we see what you're doing over there. We respect what you're doing over there, but don't count us in as far as buying that next new machine. We're good over here. That then says to me as a shareholder, the current wave that we've been enjoying is likely to go back out. And it doesn't mean necessarily that ASML is not going to be able to go find its next new customer. It doesn't mean that they won't find a willing participant who's going to plunk down $400 million to take on that next new machine they want to sell so badly. It just means that the growth cycle that they've been enjoying to this point is likely slowing down. And so I believe that I'll be able to re-enter this stock, should I choose to, in the future at a much lower price point. So why not take the gains today, go reinvest those dollars into something else that hasn't gone on that growth trajectory just yet, and keep an eye on it.
Okay, well put. I reserve right now. ASML is my largest single stock weighting in my retirement account, and I reserve the right to have that not be the case by the time you're listening to this show on Tuesday. I think that's a coherent thesis, and this is the type of company where I don't think they're selling. They sell a relatively low volume of machines simply because they cost so much and they're building manufacturing components. That said, there was, a couple of years ago, they were talking about what their back orders were. We're not able to increase capacity. And now that story appears to be turning. Something else you said in there that I think is interesting is that we're starting to see the stage in the AI story where and maybe this gets to Nvidia, companies are not demanding the biggest, baddest chips all the time. And that's something that's happening with Intel, where that stock has gone parabolic. And it's because investors realized that once the LLMs are trained, you can use Intel chips, which are way cheaper than what Nvidia offers, to run the LLMs. They're flexible enough that it works. So you train your LLM on Nvidia, and then it can run on Intel. And that's why you're starting to see that stock go parabolic. But is that kind of what's lining up with what you're seeing in Nvidia?
Yes, but before we go to Nvidia, let me say one more thing. So
Sure.
you were leaning into a direction that I think is important to point out. So there's still demand for what ASML does. They have the potential to replace the lack of business from TSM with another one of TSM's competitors. That is very true. However, the investment to build and build out, like a startup coming along trying to replicate what TSM does, the reason it's been so hard to do and almost impossible to this point to do is because it'll take $20 to $30 billion to establish a foundry here in the United States. And that is the moat around TSM that allows them to keep the pricing power and everything else with the customers that they have and so forth and so on. And so it's not as simple as saying, I'm going to flip from being a Bitcoin miner to now being a, what's the word we're using now?
AI GPU maker.
Yeah, but like the GPU ass.
GPU as a service.
I caught that from you and JMO, by the way. I'm not going to be a GPU asser. I'm going to be a, foundry, and the startup cost related to making that switch is substantially heavier than it would be if you wanted to go rent out cloud servers and, that sort of thing. So anyway, so Nvidia is a little bit different. Nvidia, to me, has been enjoying this pole position for the last 3 or so years with no real problems. They have these hiccups 3 or 4 times a year where their share price, gets down in the dumps for one reason or another, and then it makes its way back out, and then it falls again. But in this case, while it's riding high, it hasn't stopped the analysts from questioning, one, whether Nvidia can actually sell through its backlog that it keeps bragging about. And those are the questions that Jensen Huang is now having to field on on earnings calls from analysts. That's a problem to me, because it used to be, oh my God, Jensen, congrats on the quarter, man. We're just glad you called on us. We just want to pat you on the back and we'll toss you a softball just so that our name makes it into the transcript. And now, there's a lot more critical questions being asked that we didn't see 2 or 3 quarters ago. Then you couple that with the fact that Nvidia's gross profit margin is about 80%, and they are the most productive company within the S&P 500 by a long shot. The closest next competitor is Micron, I think, at 71 or 72%, and then it falls again from there. So Nvidia generates about $4 million per full-time employee. There's no other company in the S&P 500 that's anywhere close to that. For context, Microsoft, Google, Facebook, Amazon's a terrible one to throw in there because they don't give a what about these kinds of metrics.
They have a split also employee structure, unlike
that's true.
Unlike some of the other tech companies. But yeah, I got you.
But the closest competitors that I name, Apple, I think I missed in that bucket, but they're all at like $2 million per at best, like the next closest competitor. So Nvidia is basically twice as productive almost as their next closest competitor amongst the hyperscalers when you look at it from a revenue generated per employee basis, which feeds into something else I know we'll talk about later in the show. So anyway, all of that to say, how much more productive, how much larger can you grow those gross margins in a way that it's going to impress the street? So yes, you can keep growing top line revenue to heights we've never seen before. A $4 trillion company again now, firing off billions and billions of dollars. And they always somehow manage to quote unquote surprise with an extra $2 billion that they've generated above expectations quarter after quarter. But how much will the street continue to care about that? That's what I'm making that bet on. So ASML, I sold out of completely. I'm very confident I'll be able to buy that cheaper later. Nvidia, I just trimmed it by 25%. It's the second time I've done that this year, simply because I still want to take the ride. There's a chance that I am 100% wrong on this, and Nvidia goes from 205, I think it is today, to 300 by next weekend. And so I still want to participate. I just wanted to right size it because, again, to your point about the sleep number, my number is 10% is the max any one stock should represent in my own personal portfolio at the absolute most. Nvidia crossed that threshold a couple different times, and so I trimmed it, just good housekeeping, and want to make sure that I'm on the right side of right with my own personal investment policy statement.
Yeah, and I appreciate you going back to your personal investment policy statement and, watching the narrative. That's something that we've tried to do on this show. I want to pat myself on the back, or ourselves on the back. We said it with Robinhood when Robinhood was close to 150. Now it's back below 100. It's okay to trim. It's okay to recheck your thesis. I mean, I bought ASML. I was looking through it early 2025, some 2024. And that's when people were down in the dumps on it. And now there is a disconnect between the narrative that investors are telling and the narrative that the CFO of Taiwan Semiconductors is telling. So I appreciate that. Maybe later in the show, I'll ask what you're watching instead as you're cutting these positions. But, let me game this. Let me increase the retention because I got some other stories I want to talk about.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
This was a personal finance story in the Wall Street Journal, which had, I think, my jaw rarely drops reading a paragraph when I'm reading a news article, and my jaw dropped on this. So the story is they choose to go without health insurance, with increasing numbers dropping coverage because of cost. Other services provide ways to lower those medical bills. And this is a lot of about health shares, which are primarily faith-based. I don't have a huge opinion on this, but I also understand why people look at the deal they get from health insurance and go, this isn't working for me, even if it's, not quite as dire as I either eat or I pay my health insurance bill. I think it's about, people who could pay for it going, no, I think there's more cost-effective ways to do that and the risks associated with it. But Malcolm, here's the personal finance tip for you as the CFP. I'm just going to read it and get your reaction. Quote, if you are going to an emergency room, the hospital has to at least stabilize you regardless of your ability to pay. And you can try to cut a deal after the fact. You might be in a better position if you cross out parts of the hospital's consent form that require you to promise payment before you sign and then take a picture of it.
That sounds like some TikTok wisdom that could have you up the creek without a paddle to me. Like that's, do I think that that is possible? Sure. Like there's hacks to everything, every system. But now that you're sharing this publicly in an open forum, you don't think there's hospital administrators that are making sure that they have ways to crack down on this so that they don't get left with this bill? Also, just because it worked once doesn't mean it's going to work across the board.
Yeah.
So I wouldn't plan around like this being my strategy and how I'm going to game the system. Also, let me just say, it's a dangerous game in general to mess around with their health insurance, because the number one thing that throws people into having to file for bankruptcy in this country is medical debt.
Yeah.
It probably would be student loan debt if we were allowed to discharge that in bankruptcy, but that's a different sermon for a different Sunday. In this case, medical debt is the thing that throws people into bankruptcy. And it's probably a lot of younger people who think they can go without because they're younger and healthy. And then something happens and you recognize how quickly that can turn. So it's not the thing to be playing around with trying to gamble with TikTok advice anyway.
This is not TikTok advice. This is Wall Street Journal advice. It's very
But
different.
where does it start?
I don't know where it started. I just thought it was absolutely incredible that, I just got stabbed on the bus. I'm being wheeled into the emergency room. They've just got me back conscious. And now I need to read through the contract and find the part of the consent form that says about my promised ability to pay. But also I probably need to check in the contract to see that if I make any changes and sign it, therefore that contract is void, similar to like, a car insurance deal or a life insurance contract. You can't go buy a life insurance contract and cross out the part that says, we don't cover you if you lie about smoking cigarettes to us. And then you die of lung cancer and wonder why your beneficiaries just get the cash value back while you're sitting in the afterlife. So,
and like you said, while I'm fading in and out of consciousness,
I was thinking more about when I'm supposed to apply this hack, which is that I've just been stabilized by a group of medical doctors, and I'm supposed to be reading through this contract to check out my ability to pay. But I was like, unfortunately, I thought this was a representation of the American healthcare system of, make sure you're reading the fine print as you're fading into consciousness.
Yeah, what a joke. This is...
All right. Next quick-ish story is, since we've been talking about prediction markets on the show, I want to talk about the fact that they got the Maduro better. And this is from CBS News. Federal investigators believe U.S. Army Master Sergeant Gannon Ken Van Dyke, he was the one who placed the $33,000 bet that Maduro would be captured. Polymarket and he made about $400,000 on the bet. So Polymarket has come out and say, look, we're able to track insider trading, and we cooperated fully with the government in order to catch this person. And I'm looking at this, and my first instinct is, well, first of all, this bettor allegedly went to Polymarket because of the know your customer rules on Kalshi, because Kalshi makes you show your ID at the door. And when they tracked this person, part of it is because he was a little sloppy, I think, with probably his cryptocurrency accounts, tracking it to himself. So there is a possibility where this Army sergeant
could have gotten away with it.
Is a little bit cleaner. It wasn't because Polymarket is so cooperative, which maybe that's a role in it, but also the role is that the criminal was a little sloppy. And so my gut reaction too is the problem in the first place is that this market exists, that you can bet on world leaders being deposed. You can bet on military action that one person can control, or even what magic word someone's going to say in the Nvidia press conference after earnings. So I see this. I'm glad they found out who it is, but I wouldn't say this makes Polymarket more regulated even in the slightest.
Maybe this is the signal that the hardcore people who game the system needed to know, though, that somebody is actually watching and they're not all like asleep at the wheel. Maybe this is enough to deter like 50% of the people who have been making these kind of bets and getting away with it and thinking like they'll continue until somebody stops them. Maybe now you'll get at least a reduced amount of this kind of activity, which is somewhat helpful.
Malcolm is squinting and looking for a positive spin on this the best that he can. I mean, yeah, the CFTC, there was news, I think it was Reuters reported, they're looking into the suspicious oil trades that we've talked about on this show that I've covered on The Indicator from Planet Money. And I think with this, one of my other notes is that they're catching the small criminals first. They're catching the small money, the people who made 400 grand first. And 400 grand is not small money, but it is compared to the $50 million profited on well-timed futures trades before Trump posts on Truth Social that tensions are cooling in Iran. And go ahead.
I think part of the problem though is that it's the person or the people who are leading by example. So what I mean by that is the Wall Street Journal's been doing some digging and some reporting now on One Liberty coin or Liberty One coin that's owned by the Trump family and is it Schwartzman? Some high level official inside of the cabinet, plus one of the leaders from the UAE who's a very high level official, plus she's what's the guy's name? CZ is what they call him.
Changpeng Zhao.
There you go. Thank you.
World Liberty Financial, right?
They're all somehow or another circular dealers in this World Liberty Financial, which launched its own stable coin. And there's been payments that have been tracked now in the billions of dollars between these entities to each other, which are very clearly timed against policy being affected to benefit the UAE and to benefit the guy who needed a pardon from jail and to benefit basically tracking back to people in the U.S. administration, including the president of the United States and his children. So if I am looking at that and I am tangentially connected to this administration, I might be looking at that and saying, I can do that too. He's given me the green light. They have given me the green light. They've also given me the blueprint. As long as I transact in crypto, it throws the people off the scent enough that I think I can get away with it. And I think you're right. This one particular person wasn't as well versed in crime as he thought he was, and he might be the outlier, but I'm hopeful. This is the optimistic me that came into this podcast episode. I'm hopeful that this is at least enough of a deterrent that 50% of the people that would have participated are suddenly looking and saying, you know what? I'm good. I don't need a jail sentence in my life. Like my resume looks fine without it. Mm-hmm. Kind of like when you see the police park a car on the side of the highway with nobody in it. Like maybe there's still plenty of people that are going to fly past it and say, catch me if you can.
Yeah.
But maybe that's enough of a deterrent to slow down half the people that would have done this.
I think so. I think there's going to be continued problems that spring up on this. I mean, last time I checked Polymarket, you can gamble on whether or not Iran has a nuclear weapon, which is not a financial market that should exist because it's not something that I hope you don't need to hedge against.
Yeah, that's dangerous as hell.
It's super dangerous. And it's not just Americans that can benefit from this. We're getting into the part where, bad actors with a crypto wallet who are not under the jurisdiction of, U.S. federal law enforcement are also able to benefit from it as well. So that's my concern. But I do think you're correct in that, if they're arresting someone, they're trying to create a deterrent. CFTC, leaking to a big news company like Reuters that they're going to start investigating the suspicious oil trades. Maybe that's a deterrent, but remains to be seen. You got to be pretty confident if you're putting over $1 billion on the line right before a post. The next stage of this too, quickly, is that prediction market ETFs are coming. So a Democratic president ETF or a Republican president ETF. And it's one of those things where the headline on CNBC was, it will be available for your retirement accounts. But I mean, it's an IRA and you can pretty much invest in anything in an IRA. And I really doubt that most people will see this and go, I'm putting in a large allocation into the Democrat or Republican president prediction market ETF. It takes too long to explain.
Well, also, like, who asked for this? like, what is the problem that we aim to solve by doing this?
Yeah.
That's always the question that I ask before taking on any big endeavors. Like, what problem are we trying to solve here?
You do it because you can. Speaking of issues, let's go to big tech layoffs. This is a huge story that I know impacts not only the market but just human beings, and it's sort of a depressing story. But let's get into it. Meta is laying off 10% of its workforce and scrapping plans to fill about 6,000 open roles. Microsoft is announcing voluntary buyouts. If your years of employment and age add up to 70, it's about 7% of the company. And my first gut reaction to this, just from a analytical point of view, is that Meta seems to be doing these like rolling Jack Welch at General Electric style layoffs of just, we're going to keep cutting underperformers in this rolling thunder style. Whereas Microsoft is saying, yeah, we're trying to cut the old people here.
Yeah, so it got my attention because in addition to Meta, we also saw Oracle that said, we're just going to rip the Band-Aid off at one time, hopefully, and 30,000 of you suddenly have no place to be tomorrow.
Yep.
Like, and let me say too that I know this from having conversation with folks on the inside. It was a surprise to just about everybody. Like folks that literally moved recently to Texas for this job, who got recruited away from where they were comfortably employed, were part of the 30,000 that got told at once that your services are no longer needed. And we covered it before. The goal there, as with Meta, is basically to cut cost in a way that it helps to offset the spending they're doing on the other side related to building out their AI infrastructure. So Microsoft, I was interested, intrigued, and impressed by the fact that they've never actually offered in their 51-year history a early retirement option to their employees before. But what they're looking at it and saying is, instead of, I assume this is because we don't want the negative press associated with just jettisoning 10,000 people all at one time, unbeknownst to them, the same way, we'll give people the opportunity to voluntarily retire early, which I have to imagine this is one of those like first offer is the best offer kind of things.
Yep.
Where, so they already have a program internally that they call 55-15, where anybody who's 55 or older with 15 years or more of tenure is allowed to retire, quote unquote, early. And the incentive is your remaining restricted stock units that haven't vested yet will continue on their regular vesting schedule even after you've retired. Unique to Microsoft, Microsoft prides itself on long tenured employees, so it makes sense. Apple has something similar, but it's different because you got to be 60 and there's other factors that go into it and whatever. But in this case, the details haven't been released yet. They just announced this is the thing they're going to be doing. And they said, stay tuned. We'll tell you on May 7th what the offer is going to look like. But I have to assume it's got to be some sort of accelerated vesting on those restricted stock units, because that's the thing that would be motivation enough to get people to take it and get out the door. Because effectively they're saying you older people above 55 have the highest salaries here because you got the most experience, and also your health insurance is the most expensive. So because of our investments now in open AI and everything else we're doing, we have gotten more efficient. We know that we can be more productive with less people here. So we're going to reduce our head count too, but we're targeting this very specific group of people. So they basically said anybody whose tenure plus their age equals 70 is eligible for this. So that's where I came up with the 9 to 10,000 people number. It's about 7% of their US workforce. So anyway, that to me is a very different approach to solving this problem. We're committed to hundreds of billions of dollars going into the ground to build out data centers. We've even taken on debt to do it. And so now our debt service basically equals or is greater than the amount that we're going to spend on salaries over the next however many years. I respect that approach so much more.
I do as well. It's I think more ethical. They're going to vary it by individual. I think it'll be more generous. So Oracle shoved people out the door from what I saw. 4 weeks base salary plus 1 week per year of employment. That is brutal. For comparison, Meta's last round, they did 16 weeks of base pay plus 2 weeks for every year. They also covered the cost. They covered the cost of Cobra for 18 months, which is huge. To cover health.
Yeah, but everybody does that.
To cover the cost of Cobra for the full 18 months?
Sorry. Cobra's available for 18 months for everybody, but within the Silicon Valley hyperscaler crew, that's typical.
That they cover.
They'll cover it for you yeah.
And then Amazon, basically you get to stay on for 90 days of garden leave, they call it, which is that you get your full pay, everything, just don't perform work. We're going to pay you as normal for 3 months. And then after that, you get a severance package, 2 weeks of base salary at a minimum of 4. So the point of that comparison is that Oracle went through this in an extraordinarily brutal way. And you mentioned the debt load. This is a huge story. We've talked about it before. We'll talk about it again. So Microsoft was able to issue long-term debt at about 2.5% in late 2023. Now investors want closer to 6%, 5.7. And for a stock investor, that doesn't sound like a huge difference. A 2% return versus a 6% return. For debt investing, that is absolutely massive. And it's coming at the same time that they're taking out more and more debt to build up these AI data centers and the big build out you need to, build. As one former OpenAI executive told Ronan Farrow, you need to build a portal to communicate with the aliens for general intelligence, artificial general intelligence. That takes a lot of money and energy. So maybe the question I want to throw to you, unless you have a reaction, is looking at the Microsoft thing, they're calling it a voluntary buyout. I think the word voluntary is doing a lot of heavy lifting there. If you get a voluntary buyout, I cannot think of a single circumstance in which you do not take that buyout.
That was my whole point about the first offer is the best offer. Trying to think of how to say this without front running anything or getting us sued. So we have I probably, the way I'll say this is for context and the interest of full disclosure. My firm, Capital Area Planning Group, has a relationship with Microsoft where we provide financial planning services on behalf of their employees at a discount as a employee benefit.
Nice.
Which is one of the reasons I'm so informed about this and interested in this topic. With that said, I've already started to get the questions from people like, do you think that I should hold out for a better offer? And the answer is unequivocally nah. Yeah. Because to your point, in my experience, the first offer, this is as good as it gets. If you think just back to when Doge came to DC and they said, we're going to let all of you have an opportunity to voluntarily leave here. And the offer is X, and here's what you get as your package. And you have until tomorrow night to tell us yes or no. It wasn't that fast, but basically like they were like, give us your notice within a week or something. And that's that. We had that conversation with clients who said, do you think this is it? I think I'll hold out. I'll see what happens. I'm not ready to go, whatever. And then the next offer that they made was substantially less. And then they sort of cut the window where you had an opportunity to respond and just said, you know what? Never mind. You're fired. And so I don't necessarily think that Microsoft is going to be as brutal as Elon Musk went about trying to cut the quote unquote fat.
The park rangers.
But I do think that the first offer is going to be the best offer. And I think this is Microsoft specific right now because this is who it revolves around. But I think for anybody who works for one of these tech companies that has been plowing hundreds of billions of dollars into the ground to get their data centers built out, and on every earnings call, they're saying to you, we intend to keep on digging, right? Like we've dug ourselves in these financial holes so deep that there is no turning back. We intend to keep on digging to the tune of 100 billion this year, 120 billion this year, 140 billion this year. That should be sending off a signal through your brain to say, there could come a day where my company also decides to follow suit with what Microsoft has done. And so I should be getting my ducks in a row to make sure that I am prepared for when that offer comes and have decided how I'm going to say yes, not if.
And I want to be fair to the emotion of it. It's something that I have been in a similar spot before where you've been at a company for a while and this is what I imagine the Microsoft employees are going through is you've been at a company for a long time. You believe that you have institutional knowledge that cannot be replaced. And while this offer is going to a bunch of people, there's low performers that should take it, but you're a high performer. You're a star. This doesn't apply to you because you're so good at what you do. You get good performance reviews. Things are going well. And so maybe you hold off. Maybe don't hold off, but I understand the emotional reasons that people, think that and maybe don't want to take an offer like that. And then to your point of these rolling layoffs, it's not just going to be big tech companies. And there is the CFP rule, the financial advisor rule is that you need 3 months of an emergency fund if you're younger, if you have two people in your household that work and earn a living, 6 months if you're single. I'm starting to think that might be outdated. You might need a little bit more than 3, especially if you're in a high cost of living area working a job like this.
Well, so let's make sure we go through that math all the way. So young person, single, 3 months at the absolute minimum, 6 months feels better because you're one income that's going to need to close this gap.
Yep.
If you are married, 3 months is the more comfortable number because you've got presumably a second income coming into the household that can cover any gaps that way and whatever. However, I think to your point, we're getting to a place, this particular thing aside, where we all need to be thinking about 6 months of emergency reserves as our baseline period, solely because this AI displacement wave that we're basically that's what we're describing here is
Yes.
people's jobs and livelihoods and entire lives being upended by AI. It could take a while. Like it could be 2 years, 3 years, 5 years before we really know what the full implication of this is going to be. And before we see ourselves going through this valley that we're going through. So the peak in hiring was in 2020, maybe 2021, where the great resignation was all the rage. And that peak has now tipped itself into a valley starting to form, but it could take a while before we see the bottom of that valley, which means that we could be seeing an extended period of time, a much longer period of time than we normally would have, for hiring managers to get the budgets that they want and need to fill all the seats that they feel like they need to fill, because the company is saying, let's just wait and see. We don't know yet what our needs actually are. We don't know yet how expensive our new headcount will be. So let's just wait. Let's see.
And I think for a lot of these tech jobs, it's, the meta sideline, the meta comma, we're scrapping our open roles. So you're going to have a lot of tech companies laying off people. And at the same time, to your point, the hiring managers are going to have a more difficult time finding budget in there. The narrative piece of this, I think, is worth paying attention to. AI was supposed to take your job because there was going to be a bot that did your job so much better than you, and you only need 2 seats on your team versus 10. Now what we're finding out is AI is taking jobs because the companies are spending so much money on the build out and debt is getting more expensive that even the companies making this AI future are struggling to, are not necessarily adding jobs. And I don't have a great thought on it other than it's worth paying attention to.
Yeah, that's again my point. Like we just don't know yet.
Yeah.
And so because we don't know, it could take longer than the textbooks have taught us that a person should expect to be out of work and need to rely on their emergency reserves following severance. And so because of that, this is a point where it makes sense to be building up those cash reserves a little bit better than you had before because of those unknowns.
All right, I want to do an EV story and then twist it into a stock story. Do you have anything else you want to add on that? I feel like we had a good amount of time there. This is a consumer angle I want to chat about.
Let's talk about it. I'm interested in EVs too, and whether they're going to make a comeback at $100 oil. So let's talk about it.
So far, there's been, according to Edmunds, $100 oil has led to, what did they say? Consumers are nudged towards EVs, but it hasn't been a shove. Have I told you my story about leasing a Nissan Leaf in Colorado about a year and a half ago? Okay. So I had a car, it burned out, think it got to like 250,000 miles or something. And so I was like, all right, I need a new car. And in Colorado at the time, they had federal incentives plus state incentives for EVs, plus another state incentive if it was an affordable EV. So Nissan and Hyundai, to an extent, had the Leaf, which is their affordable EV. And by the math I did, they were able to get those cars out the door for essentially less money than the depreciated value that they said they would be. So because, we expect this to go from a $30,000 car to a $20,000 car, but we're getting close to $15,000 worth of, incentives. So there were deals in Colorado, one for the very base version of the Nissan Leaf. This is like a lower mileage battery. You're not getting seat heaters. Worth checking the airbags in there. Worth checking the airbags in any car. I got the upgraded one. So the base version was, I think you could end up doing $0 down on a brand new car, $120 a month. And
wow. Okay.
And I paid $1,000 down and $100 a month for my leased vehicle, which is pretty good. I don't know if that comes back. I was pretty happy.
You went home feeling like you got over on the system.
Exactly. And the first dealership I went in, and I should have taken the deal there. I went with my wife, Sam, on a weekend. And it was the only time I had this experience in a car dealership where, we check in, it's way understaffed. We're like, yeah, we're interested in leasing a vehicle. And the person's like, all right, we might be able to find someone. And one of the most tired people I've ever seen in my life comes and sits with us at a table. And he goes, okay, I am willing to help you lease this car. However, you need to understand that we're very short-staffed right now. It might take a minute, and we're all going to be patient, and we're all going to behave, and we're not going to raise our voice. And I was getting a behavioral lecture because it was actually one of those cases where demand was so strong and they were so understaffed that they couldn't deal with what was going on. And I even knew in that moment, I'm like, I'm existing in a moment in time that cannot last forever. And then I asked, I'm like, I think Sam asked, like, well, why don't we just buy it? And he goes, you do not want this battery after warranty. And so I was like, oh, this is going to be a problem for Nissan. If everybody knows you don't want this car after 2 or 3 years or deal with the battery replacement, and all of these are going to be coming back to dealerships. So that was a microcosm of what happened. People were getting some deals with the federal rebate. Colorado was extra generous. California was generous as well. And so here's what's going to happen. In 2025, this is according to Cox Automotive, 123 leases for electric vehicles expired. Next year, it's going to be 600,000. So 123 to 600,000. And the number of used EV sales, I think last year was close to about 300K. So you have a huge supply glut that is coming back to these dealerships and these vehicle financing departments going, oh, maybe we made the residual values a little too high. Maybe we aren't going to be able to sell these Nissan Leafs for $20,000. These might be going for closer to $15,000, $10,000, even with the federal tax credits going away. So this is an issue that General Motors, which had a lot of electric vehicles, they've slowed down on investing in them. They even admitted it in their latest because they report the morning that this episode drops. Quarter before this quarter, Mary Barra admitted that demand was slowing, and the CFO, came in and said in financial speak that, quote, lower lease termination gains, end quote, hit the financial division's earnings, which the translation for me says, oh, we can't get rid of these leased vehicles like we thought we could. And so we're now getting to a point where the average cost of a used electric vehicle is close to the average cost of a used gas-powered vehicle. So I think the angles are twofold. One, how does this affect Tesla? Is it even a car company? Does it matter? I don't have a great take on it, but it may start affecting these legacy car makers even more if they have to do these write-downs and exist like a normal stock does. So I'll end my rant there.
So I think, though, one of the things that will matter, and this is where it comes back to the house always wins one way or another. So where it comes back to these companies is because you just pointed out that the battery outside of warranty is going to be a problem. I am on my second electric Grand Cherokee now, and I get a recall notice every 3 months that something related to the battery needs to be addressed one way or another. In one case, they ended up just completely replacing one of the batteries on it. And like, that was the fix. In other cases, like it's simple and they have me out of there in 30 minutes. But anyway, I don't want to be owning that vehicle when I am the one who's responsible for paying every time I bring it in to have you address the battery issue. But that is where the dealer is going to make that money back. So everyone out there driving around in these EVs that are not under warranty anymore still needs to get the battery fixed, because the cost of not doing it is basically the same as going and buying a new vehicle. So it's 6 in one hand and half a dozen in the other. So that is where the parts departments, the repair part of the organization, they will start to earn back a lot of these dollars that we're talking about they have lost on this trade.
I think that's true, but also just the sheer supply glut that is coming next year is going to prove to be a problem. Like, that's an immediate hit that these companies take. And I think the message is kind of out that, you know, depreciation for electric vehicles is much harsher than gas powered vehicles. So I think like there was a New York Times article. The example was a Hyundai Ioniq 5 where the author found, the car's new MSRP was about $58,000. 2 years later, about, I think, 50,000 miles, $28,000. So these cars get cut in half pretty quickly. And it has to do with exactly what you're saying. So I think consumers are pretty hip to it. And that's also why you're seeing the company with the lower depreciation rates relative to other ones seems to be Tesla. Because those ones, they have a reputation where these cars can go for 100 miles. And say what you will about Elon Musk, people really like their Teslas that own them.
That's the unfortunate part about your question about whether they are still a car company. That's what makes it unfortunate, is, in my opinion, if someone other than Elon Musk was the CEO of Tesla, all they would need to do is roll out 1 or 2 new models that fit a size requirement that doesn't already exist. So like an oversized SUV, like an Expedition or Yukon or something like that, that's on a fully electric platform. And then some other type of everyday car that is also missing from that lineup, maybe a coupe or something. Like, those 2 things would be enough to get, a third thing would be to refresh the body style, because it's looked the exact same for the 15 years those things have been on the road. And like, I'm tired of looking at it. So give us a new body style, some new lines on it, a reason for people to upgrade to the next one.
Like a Cybertruck.
Okay. Let's not. They need to throw that in the trash. But do something so that it incentivizes people to upgrade to the next new one, because we're a consumer culture. We like to show our neighbor that we're doing better than them. So give me a reason to plunk down another $100,000 to get the newest, hottest thing. And those are enough to turn Tesla into a legitimate competitor against like a GM or a Toyota or whoever else as far as volume of sales. But because we have a CEO of that company who's more focused on launching rockets into space than he is running a car company, he's churning out, fighter robots now. That's never going to happen. But I think it's unfortunate because there is a ton of opportunity in that Tesla brand and their first mover advantage and the quote unquote cool factor that we're never going to see.
He's always been interested in launching rockets into space. I think I take your point though. The part I want to get to is the stock angle, because as we talk about Tesla, one surprising thing that you may notice as a listener, hopefully that you notice, I'm about to tell you, so you won't notice, you'll hear it. Since late 2022, General Motors stock has outperformed Tesla. And I think the reason for that is, a bunch of reasons for that, but one primary reason is that's when General Motors was reborn on capital allocation. So late 2022, GM brings back its dividend. Then starting really in 2023, 2024, Mary Barra starts ramping up the share buybacks. So they start going to financial engineering a little bit more. And there is a tremendous cost of going too hard in the paint on financial engineering in the long term. There's a great YouTube video from Modern MBA about how Moneyball ruined your favorite snacks, because once you go down this road, you start, cutting the number of the number of noodles in the mac and cheese packet, or Hershey has to go back on its new recipe because it was using, quote, too many chocolate alternatives. You don't want to see that happen necessarily for cars, but finding companies that are kind of repivoting towards financial engineering can be a good place to look for companies. And I have one that I'm starting to pay more attention to after I started going through this process in this story. And that is Vail Mountain Resorts.
Okay.
Because it is coming off one of the worst. I do not own this stock. I reserve the right to buy this stock. I do not own it right now. It's coming off one of the worst winters ever in Colorado. And skiers and snowboarders especially, they like to complain. The room rates are too high. The snow's not good enough. I'm never going skiing again. Guess what's going to happen when there's a good winter? They're going to immediately forget about it, go back to the slopes, and pay thousands of dollars to stay in hotels for the privilege to do so. And Vail Mountain Resorts, right now, it's kind of been ramping up buybacks. And not only that, the CEO has bought about $5 million worth of shares on the open market, which I think is a meaningful number. So, and importantly, insiders have not really been selling the stock over the past year. So this to me says insiders are realizing maybe this is a cyclical business and we're in a down part of a cycle. So you have a company that has a lot of heat on it, with, weather patterns are more unpredictable for ski slopes. This was one of the worst winters they've had in decades. And so this is what I'm paying attention to a little bit more. I think rich people still like to ski in the K-shaped economy. Looks like they're doing some financial engineering, which is unequivocally bad for the employees, but probably good for the shareholders. And it doesn't look like insiders are selling.
So for context, it sounds like, though, you're framing this as a really good trade opportunity, not necessarily a long-term investment.
Trade in the term, yeah, because that would be probably like you're buying it with the intention to revisit selling within 1 to 2 years. And my investment policy statement is 3 years minimum.
A cyclical investment, a cyclical investment sounds like an oxymoron to me, because if you think about like chips, right, in the way that they used to perform before ChatGPT,
sure,
it was always these boom bust cycles where we know we're going to make a whole bunch of investment in the new round of chips. Then there's going to be this 2 to 3 year period where the current chips are fine and they do what we need them to do. And then companies want to upgrade to the next newest handset or PC or whatever. So we got to invest in the next round of chips. And so you'd constantly see these 2 to 3 year roller coaster dips. And in the case of something like that, well, I don't want to be invested in that necessarily. I want to just own it when I know that they're in the valley and ride it all the way up to the peak and sell it. That's what I would hope to do, at least. And I think that sounds like what you're describing. I'd buy it at the low. They had a terrible winter, not just in Colorado, up and down the West Coast, and then also parts of the East Coast, even though the East Coast did get thankfully dumped on a little bit. So some of the resorts that Vail owns on the East Coast did okay in comparison to just desert that existed on the West Coast. But once they have an earnings call or two where they talk about how great this year's, 5 feet of snow that dropped on us miraculously and how awesome it has been for shareholders, once that happens, I mean, what else can we do? So I'm assuming this is a trade at that point.
So I see it as well. I also think it's one that, this company's been on a slide since I think 2022, 2021. But, maybe there may be a little narrative shift if they have demand pickup due to a good winter. And to be clear, I'm not predicting the weather here. There could be another bad winter that hurts this company even more. But they have a pretty strong moat. People like to ski. It's one I'm watching that I have not pulled the trigger on.
So something I know we'll get into in a future show is Tim Cook leaving Apple.
We didn't do that.
And the impact that that's going to have on all of us. But when you talk about financial engineering coming back in vogue, one of the things that I was thinking about, and I actually read somebody else's writing on that, I don't remember to give them attribution at this point, unfortunately, but the fact that Tim Cook's legacy, part of Tim Cook's legacy is going to be making Apple the best share buyer backer in his 15-year tenure.
Yeah.
And turning it from a company that throws the best new gadgets out there into the ether and they happen to stick. People love them and they want to own them under the Steve Jobs era, turning it into a really good financial engineering company, because shareholders probably don't even notice or feel or see just how much Apple buys back its own shares in the open market in a way that lifted the share price, especially in this period where everybody's asking these questions about Apple's AI strategy and where are they. The stock performed fine, right? It was flat to positive that entire 2 to 3 year period. And one of the reasons why is because they are such aggressive buyers back of their own stock at the tune of $100 billion or more per year.
And as we start to ski toward a close here, Malcolm, I did promise at the beginning of the show when you said you cut a couple of companies. Is there anything you're adding to or watching more now?
So I did just add shares of American Express. I might be adding to that position. It's a boring gazillion year old company that, you know, the story is kind of old, except that they have been turning the corner and basically leaving behind mom and pop consumers very openly and intentionally. It used to be a thing where you knew American Express only wanted premium customers, but you still signed up anyway. Okay. Now they are very clearly and aggressively only going toward the top end of the K-shaped economy. And I, as a shareholder and also a card holder, can appreciate it. And what I'm noticing is, especially in their earnings call, I had said something out loud on one of the CNBC shows about the fact that, like, American Express Platinum card holders don't care that gas is above $4 per gallon. And the CEO of American Express basically said almost the exact same thing on their earnings call. And I was like, yeah, I could tell. And so anyway, by them leaning harder into going after that premium customer, the Platinum card holder who's willing to pay $800 a year to not have to wait in general admission at the airport, that customer is a place that I'm looking for additional opportunities to invest in that trend, because that is very clearly the separation that is going to persist in this country for some time, at least while we have this administration. And I think there's probably plenty other ways to play that trend.
The K-shaped economy worth paying attention to.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be, a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.